exactly how to trade the EUR/USD. EUR/USD is the currency pair representing the exchange rate between the euro and the US dollar. You watch the macroeconomic indicators, you read the central bank minutes, and you keep your risk parameters perfectly dialed in. Then there is Bitcoin. While traditional financial markets cruise at a steady, predictable pace, Bitcoin often roars past with daily price swings that can wipe out or double an account before lunch. Moving to a standard spot crypto exchange means leaving behind your professional charting setups. You suddenly have to worry about securing digital wallets and private keys, and betting against the market, going short, becomes a logistical nightmare. You do not have to throw out your proven trading methodology to capture that massive upside. You just need to translate your existing Forex skills to fit this highly volatile asset class. The most efficient bridge from the traditional fiat environment to the modern crypto landscape is the CFD. A CFD, or contract for difference, is an agreement to exchange the difference in value of an asset from the time the contract is opened until it is closed. This diagram illustrates two ways to gain exposure to crypto. On the left, you buy and store the actual digital coin in a complex digital wallet. On the right, you trade the price difference of Bitcoin against the US dollar through a clean contract. That contract integrates directly into MT4 and MT5, popular electronic trading platforms used widely by online retail foreign exchange speculative traders. This allows you to execute seamless short positions and eliminates the counterparty risk of dealing with unregulated offshore crypto exchanges. By stripping away the logistical headaches and security flaws of direct crypto ownership, your focus remains entirely on the price movement itself. To anticipate where that price action is heading, you have to stop waiting on the European Central Bank. Traditional central bank interest rate policies simply do not drive this market the way they drive standard currency pairs. Instead, you watch the halving cycle, an event programmed into Bitcoin's code that cuts the reward for mining new blocks in half approximately every 4 years, reducing the rate at which new coins are created. This mathematically programmed supply shock is a native catalyst for long-term price action. Massive capital inflows from mainstream finance also act as primary bullish catalysts. When Wall Street announces institutional adoption or launches spot Bitcoin ETFs, the market reacts violently. An ETF, or exchange-traded fund, is an investment fund traded on stock exchanges that tracks the price of an underlying asset. A scheduled non-farm payrolls report gives you time to prepare, but sudden crypto-specific legislation or major regulatory shifts from the SEC do not. The SEC, or Securities and Exchange Commission, is the U.S. government agency responsible for enforcing federal securities laws and regulating the securities industry. To survive, you swap your traditional economic calendar for a highly attuned radar pointed squarely at network upgrades and institutional adoption news. The hardest adjustment for a Forex veteran is the sheer scale of the daily price swings. What looks like a massive breakout in fiat is barely a blip on a crypto chart. This chart shows the dramatic difference in volatility between the two markets. Looking at the average true range, a daily Euro-USD swing is measured in dozens of pips. Average true range, or ATR, is a technical indicator that measures market volatility by decomposing the entire range of an asset price for that period. For Bitcoin, that daily swing routinely spans thousands of dollars, dwarfing the low-amplitude wave of traditional fiat. To survive that noise, you must drastically widen your stop losses. A tight 30-pip stop will get destroyed by normal intraday fluctuations, and you have to plan for execution slippage during major news events. Because of this extreme movement, brokers and regulators strictly cap crypto leverage at much lower ratios, often around 10-to-1. This is a necessary mathematical constraint designed to protect your capital from sudden flash crashes. You cannot rely on your standard fixed lot sizes here. You calculate your precise position size based entirely on that widened stop-loss distance, ensuring your total capital at risk remains exactly the same as your Forex trades. Trading Bitcoin successfully doesn't mean avoiding the risk entirely. It requires you to mathematically shrink your exposure to match the asset's violently expanded range. Because Bitcoin's value relies heavily on human sentiment and retail speculation, your standard technical analysis is highly effective here. The major support and resistance levels, trend lines, and moving averages you use every day map perfectly onto Bitcoin's price action. But to navigate a market that never closes, you need a heavily regulated broker offering tight spreads and the deep liquidity required to minimize execution drag. Your previous experience with currency charts gives you the exact vocabulary needed to navigate this market fluently. Open an FXNX demo account today. Practice translating your proven strategies into the crypto market, entirely risk-free.